In these turbulent times, it is pretty hard to work out where investors should be putting their money. Your suggestion, the first suggestion that I thought was interesting, is in developed economies in terms of equities rather than emerging markets, which seems a little bit counterintuitive because we keep hearing how well the emerging markets are doing.
Yeah, we don't disagree that there is great growth opportunities in Asia, China and the emerging markets. Really, we just observe that actually you can buy that growth here in London, in the UK stock market, for half the price. Really? And I think that's really our observation. I think people underestimate actually how much earnings in the UK come from non-UK sources. So only 27% of the UK earnings from the UK stock market come from the UK. The rest is actually from the rest of the world. And so you buy that emerging market exposure through big companies like Unilever or BP or Glaxo, etc.
And you're missing out on a little bit of the volatility. Is that your thought?
That's the idea, yes. I mean, there's obviously a currency call there as well. But our thought is that, yes, we do see that growth continuing in those regions, but we think it's a cheaper way to play it this way. We also actually see that the US is, of all the developed countries, is clearly showing signs of economic recovery. And I think that's the structural change we've seen this year and why we see US equity supported from here.
US futures, of course, as you say that, of course, US futures are going down this morning. Yeah. But that's always you're looking at a short-term, medium-term on this.
We have a short-term view into what we think in the next 3 months, and we also have a structural view on what we see in the next 12 months. I think on the 27th of April, we bought protection in the morning because we felt the markets have run too far, too fast. You see a correction, and we're now looking at, does this provide us with opportunities to reinvest? I think we talked about this before we came on, the notion markets trade between greed and fear.
Yes.
We saw fear last week, and we saw greed on Monday, and we're now really trying to work out the significance of that package that's been put together. I think underlying all this that we miss and what we as equity investors are looking at on a day-to-day basis is what the companies themselves are saying, what our earnings reports are saying. And actually, yet again this morning, earnings reports have surprised on the upside. And I think that's the factor that we look at. Obviously, if there's a big macro issue out there that we're not dealing with in terms of the sovereign side of the equation, that will impact equities going forward, the discount rates we should be applying to those future earnings. But our thought is that Europe has taken a major step forward. It will take time for the markets to digest the impacts of that, and whether Greece responds fiscally to the opportunity that's provided by the ECB, and likewise in the UK, digesting what does a coalition government mean? Are they going to be disciplined? I think what's been really interesting out of that statement from the coalition yesterday is the fact that they want to align themselves with the views of the Bank of England. So they're going to make cuts which the Bank of England think are prudent. I think that's really quite phenomenal that politicians are giving more control to the Bank of England.
Now, you say you're looking at the bailout package. We're seeing the euro fall quite sharply this morning. Does that concern you?
Well, euro actually has been sort of a store of value for a long time. I mean, we've thought it's been expensive for a long time. And the reason, I mean, if you think UK used to trade in a range of 60 to 70 pence to the euro. Yes. And when Northern Rock went bust in the late summer of 2007, we suddenly saw that 70 pence go to £1 to a euro. And all we're seeing now is a healthy retracement. As we're addressing our problems fiscally and from a debt point of view here, so sterling strengthens. I think, interestingly, we've seen, with the US economy showing signs of recovery, the weakness of the dollar that was before is now recovering, and the dollar's recovering. Yes, euro has addressed a problem, but I think it's raised the question, and because they were so slow to respond and then had to do something ginormous over the weekend, that markets aren't as confident that maybe the euro is as strong and as stable source of value as it thought.
Piers Hillier, thank you very much indeed for joining us this morning.
Pleasure.